This is how I think of a successful investment strategy. So, in order for a strategy to be successful for you, in order for you to have, or basically a framework for you to think about which strategy you should pursue, I think of three aspects that would make it successful to you. The first one is obviously needs to make money. So obviously, if there's a strategy that doesn't make money, like coin flipping, for example, then it won't work as a strategy for you. So that's easy. That's the easy part. The second part is the strategy actually implementable? And some strategies work on paper, but do fail. In this case, I have trading costs and scale issues as reasons why some strategies could work. So they may fail in real life. A lot of micro-cap strategies are like that. The bid-ask spreads are just too wide, or the cost of trading is too big. And once actually implemented in real life, they're not so great. And the other part is, again, same example with some micro and small cap strategies, that they're not scalable. So they may be strategies that work for your personal portfolio, but they may not be something worth pursuing as a career because you just can't deploy enough money into those strategies. And even for you, at some point, if you're successful enough following those strategies, you find yourself stuck without a strategy down the line because they just don't scale well. And there are a lot of examples like that. It's just not only in investing in public markets, but in other businesses and opportunities. And then the part that I want to focus on now is that whether the strategy is implementable by you. And I think this part is the part that's often ignored. And there are many reasons why there could be a strategy that is successful in the market, is successful in theory, successful in the market, but you may not be able to successfully execute it as an individual. And I've put up 4 reasons here why I think strategies that could be successful for someone else may not be successful for you, but they're just 4 examples. There are probably more reasons. So, for example, Soros and Simons, if I wanted to follow in their footsteps and follow their strategy, I think I'd fail because I don't think I have the skills or the tools to copy them. So I don't think I have the macroeconomic understanding that Soros has, so I don't have the skill to follow his strategy. And I don't think I have the tools in terms of technology and a bunch of rocket scientists sitting with me developing algorithms that Simons has in implementing his strategy. So without these two, I'd fail in copying them. And the other two that I think are very important are the psychology and enjoyment. The psychology part is very interesting because I'm of the belief that a big chunk of basically inefficiencies that can be exploited by active investors and generate alpha in the market have a very big component of them due to inefficiencies that are driven by behavioral biases. And so your psychology has to fit the strategy that you follow in the sense that it has to work in a way that overcomes those biases in the situations that you're going to be exploiting. Otherwise, if you're exposed to the same biases and you're not doing anything else different versus the person sitting across you on the other side of the trade, this strategy will fail. Value investing, for example, is one of the things that you need to be successful in value investing is to have somewhat of a contrarian streak. So that's one psychological aspect that I think applies to value investing. Some strategies require very active trading on a daily basis, hourly basis, things like that. And you may not have the psychology for that type of strategy. You may prefer to sit around and read and understand things. And so I think the fit between your psychology and the strategy that you pick is extremely important. And the last part that I have here is that the strategy also has to be enjoyable. And the reason I say the strategy has to be enjoyable is twofold. One, most strategies will require a lot of work on an ongoing basis in terms of improvement for 2 reasons. One, the market eventually catches up to the first thing that you discovered worked. So you have to continuously improve, continuously find new things that work within that strategy. And unless you enjoy it, you're not going to want to invest that R&D basically in developing the strategy on an ongoing basis. The other reason I think enjoyable is important for implementing successful investment strategy is that life is just too short. And you should not sit around every day of your life doing something that you hate. And by the way, work is the largest component of your day. So I think that in and of itself is a worthy reason.